there's some conversations about inflation out there.
Let's talk some inflation.
Questions coming on it. We just got it this morning, 9.1% month to month. Well, it's a year over year increase, but relative to last month, it was 8.6. So it's up to 9.1 now. And I think it raises a really good question, two questions. The first being, okay, we're at 9.1. What's the expectation going forward for inflation? Second question, what does that mean for me as an investor? How is that going to impact my investments as a long-term investor?
Yeah, you're right on that. I mean, look, the reality is we're all feeling inflation right now. I mean, you go to the grocery store, you go and you fill, your car up with gas, and we're dealing with that. In fact, someone here at Dimensional grabbed this picture here, which I thought was just absolutely perfect for describing kind of what everybody's feeling around inflation. And I literally filled my car up this week, and I was feeling that it cost an arm and a leg to fill that up. You can trade your soul for Supreme, and then of course, if you want diesel, you can give away one or two of your kiddos.
Which I'm fine with that.
It depends on maybe how they're behaving at the time. But all kidding aside, I mean, this is what we're ultimately feeling right now, and we know we just got the 9.1 number that came in. So as consumers and as people operating within the economy, we're dealing with it. As investors, what we want to think about is, what is it on a forward-looking basis? What are the expectations that are ultimately baked into it? So here's what we got in terms of year over year, 9.1. And what I want to show on this next chart here, or on this next bar that I'm going to put up, is what's the inflation expectation looking out 1 year? Now let's explain what we mean by that inflation expectation. What that is that's the difference between a TIPS bond with the government, and that's a Treasury inflation protected security, which means I can loan money to the government, and any changes in unexpected inflation that come up, I'm actually compensated for as an investor. So it's the yield on that TIPS minus the yield on a nominal, just a regular bond from the government. And that difference between the yield is the expectation that the market's telling us going forward. So even though we have this 9.1% year over year, we just dealt with that. That's the past 12 months. Looking forward over the next year, the market's saying, on expectation, we actually think that inflation's going to come down. And if you take and you move that all the way out to a 30-year, interestingly enough, you start to see that pretty much decrease all the way out to 30 years. So again, we're dealing with the 9.9 in terms of that's what we're experiencing right now. But as an investor, what I want to know is what's the market pricing going forward? And at least looking at this, and this is as of this morning, the market's pricing that looking forward, the market expects inflation to come down. Yeah,
in about a year. I think those are striking numbers and good perspective to keep in mind. I think the other thing to keep in mind there is as new information is released, those numbers are constantly being updated and revised. And you got a great example of that, looking at, again, using a 1-year number. So explain a little bit what we're looking at here, because it's a very powerful slide in terms of how markets are absorbing that information.
Yeah, so what you're looking at here is this is that 1-year break-even inflation rate, which is that first blue bar that we put up on the previous slide. And because it's a market rate, it's going to change through time. It's being priced every single day by market participants. And what do we know about market prices? They're changing every day based on new information as it comes out. So if we go back to January of 2021, we can kind of see it, a little bit of spike up there, and then it kind of goes along flat. And then we hit this 2022 period. And new information starts to come out. Some of the information may be, hey, all of this talk about supply chains that we thought was maybe going to clear up, maybe it's not. We had some events, some tragic events over in Europe and in Ukraine, which affected energy prices, which affected food prices, which affected global trade and many other things that were going on. So what do you see? The market starts pricing in an increase in inflation expectations looking forward. It peaked back here on March 25th. Now, interestingly enough, it has started to come back down. Now, why exactly it has to come back down? Many different factors are going to impact that. Maybe it's perspective on supply chains. Maybe it's perspective on energy prices. Maybe it's concerned about decrease in economic activity. Who knows what it is? But what I can do is I can look to the market for information about, in aggregate, what do we think inflation is going to be going forward? I find this chart absolutely fascinating. Just look, every single day that thing's being priced.
Yep, absolutely. And I want to take a look too then, how does it impact us as an investor in terms of our actual returns? So let's start with stocks around that and take a look at, does inflation impact what we're seeing year to year in the stock market? So what we're looking at on this chart is the bars are the return of the S&P 500, but I want to clarify, it's the real return. So it's the return minus inflation. It's effectively saying how much the stock market in any calendar year is outperforming inflation. And then those little yellows, we like to call them lollipops, that is what inflation is for that particular year. So you just kind of scan that page and say, there's no real relationship between what inflation is doing and the returns of the stock market in any given year. Now, the challenge, though, on this chart with where we are today is, outside of last year, I think the highest number inflation got was 4%. Okay, well, inflation is not 4%. So let's go back in time to another time period where we did see inflation be much higher than where we are today. And so now we're going back 30 years prior. So now we're looking at 1960 through 1990. And you scan that, just again at a high level, do you see a relationship necessarily between inflation and what the market's doing any given year? And I want to focus your attention on that period right in the middle, which is where we have seen much higher inflation. And not just in any given year, a little bit of persistence perhaps over a year to 3 years with higher than average inflation. But let's go back to that 73, 74 year on that chart again. And we did have a time period there where we did see inflation go up. It's pushing a little bit over 10%. I think it was 12.3% that year, if I remember correctly. And you had a pretty rough time in the market. There's all kinds of things. I think some people probably remember sitting in gas lines, oil embargo, all kinds of things happening there. But look at the next year. You see pretty high inflation over a year or two, and you see very good returns in the market, and you kind of can see that continue. So again, as much as we want to try to simplify the world to say, hey, this means that for our returns. Inflation will mean this impact on stocks. Interest will mean this impact on stocks. All of that's embedded into our stock prices. And again, there's a forward-looking nature to that. So I just wanted to highlight that. You can't just say this is going to mean this to our stock portfolio. But it does bring up, I think, your question, though, of how do you address inflation? Because it is incredibly important. It has a huge impact on our purchasing power. And so there's really two ways to think about it, right? How do I outperform inflation over time? And then maybe should I hedge certain aspects of inflation, the unexpected aspect of inflation?
Yeah, that's really what you want to do with inflation. I mean, look, we're staring some high inflation, and it's staring us in the face right now. So what do we do as investors? Get really clear on your goals. And there's a subset of investors that they do need to perfectly hedge unexpected inflation. They may have more immediate liabilities that are sitting out there. They're sensitive to inflation, and therefore any changes in inflation, that unexpected component, they have to be compensated for. Great, there's awesome ways to do that. Treasury inflation protected securities, we mentioned those, as well as other strategies such as real return. Awesome opportunity to connect with your advisor if that's one of your goals. When you talk with investors, though, a lot of them aren't necessarily trying to perfectly hedge inflation. They're trying to outpace inflation. So let's examine that, and let's stick with some of those high inflation periods, because by the way, you don't get questions on inflation. We don't get questions on inflation when it's low. Advisors don't get it, and investors are not concerned when it's low. It's when it's high. So what we did is say, hey, let's look at US inflation, and let's look at above median years here. So some of those high inflation years, many of which Mark cited here in that previous chart. And what we wanted to do was say, okay, so how do different asset classes perform in high inflation years? And let's first take a look at Treasury bills. Now you see a negative return there. That is not saying that they had a negative absolute return. That is saying that after accounting for inflation, they failed to keep pace with inflation. You lost purchasing power being in something like a Treasury bill, short-term loans to the government, kind of a cash alternative. What about bonds? Because we hear that bonds are going to get hammered in high inflation years. Well, what does the data tell you? Actually, government bonds and corporate bonds outperform. Remember, this is return above and beyond inflation. So huge return above inflation? No, but positive. What about stocks? One thing we know is that if your goal is to outpace inflation, stocks are a great way to do it. At least historically, we've seen that they've done well even in high inflation years. And you can look at the subset of stocks, some large cap growth and some small cap value. The reason that I like thinking about it this way is, look, inflation, I think on the surface can be a little bit scary. We're dealing with it. As an investor, just get clear on your goals and you have the tools to accomplish it. I mean, we talk about it all the time. I love to work around the house, Mark, and I go out to my tool bench, and when I can find the exact tool to accomplish the job, I literally get a smile on my face. And I think about inflation that same way. Yeah, it's a little bit scary. Yeah, it's expensive day to day. But as an investor, if I get clear on my goals, I know what tool to use.
Yeah, well, I don't like doing any of that stuff, and I'm no good at it. So I hire it out, and that puts a smile on my face.
Outsourcing.
Oh, really? You outsource it, brings in the role of the advisor.
That's a good point.
Around, the customized needs of the investor. Some may need to do that hedging, get with the advisor. They can work with you because it really is an individual scenario.